So we got a couple questions here. You ready?
Yeah.
Okay. So got a question here coming in from Monica Asher. So how long in advance should one get pre-qualified before looking?
I would say, if you're thinking about buying, the sooner the better, way in advance, because we can look at the whole situation as far as your credit. You might have stuff on your credit that you don't know that's there. That gives us a time to actually work on fixing the credit, and then coming up with a strategy that best suits your needs as far as, what kind of loan program should we be looking at? Are you going to need to save up for a down payment? There's so many different factors that go into that. So the sooner that you can get pre-qualified, the better, or just getting in to talk to a mortgage lender.
Yep, absolutely. So got another quick question here from Monica. So she knows it's different in the lower 48. Basically it takes about 30 days. It is a little bit longer up here, Monica. Usually to close up here, it's going to be about 45 to 60 days. And that's just kind of a ballpark average. My all-time record, fastest offer made to closing table was 11 days. Oh, look at you go. Look at you go. We obviously weren't on the same transaction. We both don't have the same record. But yeah, it was 11 days, but the longest I've ever had it take, I think it's the one I'm in right now. And it's, I think we put it under contract in January, and hopefully we're going to close in a couple weeks here. Fingers crossed. So yeah, usually it's going to take about 45 to 60 days.
Mm-hmm.
All right. So we did also have a question that came in from Sean. Let me see if I can actually pull this up here. And this is a question that came in earlier, just in the community section on the YouTube channel. So his question was, I would like to ask about how the VA IRRL refinancing works, and if it can currently give you a better rate than market. So this sounds like a lot of witchcraft to me, so I'll let you take it.
Yeah. So for the VA, for most of you, if you're not sure, the interest rate reduction refinance loan is a mouthful, so they call it IRRL for short. But that one right now, it really depends on where your current interest rate is. And if you're refinancing now, if the rate's higher, that's not going to make any sense for you. With the IRRLs, you do have to show that you're at least breaking even, and it's a better fit for you within 36 months of closing in that loan. So I would say for people that have locked in interest rates that are higher now, maybe the end of this year, beginning into 2024, if we see rates coming down, that's when I would say, hey, now it's time to do an IRRL.
Gotcha. So is it something where you would feel confident enough to where it's kind of make or break if you get that lower interest rate? Like, I've not really done anything with IRRLs before. So
the IRRL is literally designed just to get a lower interest rate.
Okay.
That's why it's in it. Yeah. So if they're not getting a lower interest rate, there's no reason for them to be doing that.
Gotcha. Okay. So it's strictly like refinancing, and it's within like 36 months of having closed.
That they have to recoup that cost.
Oh, got it. Okay.
Yeah. So that's just one thing that when we're looking at those, that just making sure that one, they're getting the lower interest rate, and then the cost isn't, exceeding a certain period of time for them. But right now, for somebody, if they came to me, it would be really hard pressed to say, yeah, an IRRL is going to benefit, unless you have a 9% interest rate.
Yeah. The thing is, okay, correct me if I'm wrong, but once we start going into this market where the house prices, those are all going to predictably, they're probably going to stay about the same. Theoretically, we'll say that. Approach everything like it's science and this is a theory. And theoretically, home prices are probably going to stay pretty stable, but you're probably going to start feeling a lot of angst and anxiety from people inside the industry, because the number of properties actually selling is just taking a cut year over year.
Mhm.
So for people that were kind of getting by before, like it's kind of the natural cycle, they kind of get washed out every 3, 4, 5 years once we kind of go through one of these cycles. So you're probably going to start like feeling a lot of anxiety from a lot of the folks that you're working with in the industry. That's not necessarily a sign that the market's like about to necessarily tank or anything. And I totally forgot where I was going with that. So we'll put a pin in that and we will circle back to it later.
Yeah.
So we do have a question coming in here from LinkedIn. So I've been self-employed for ages, and both my wife and I are getting jobs over here, having troubles getting a home loan. And how do we, how long do we need to be employed for our W-2s to count? Okay.
So they're self-employed now?
Yep.
Okay.
So I'm sorry. Been employed, self-employed for ages, and both my wife and I are now getting jobs over after having troubles getting a home loan. Put it that way.
Okay, so no longer self-employed, W-2 wages. If it's in the same line of work, or we can tie that together, I mean, we could look at using that income now. With self-employed income, there are some portfolio loans out there. And for those of you who don't know what a portfolio loan is, it's where it's not conforming, it's not going to an investor. The banks are holding on to this. This is something that they would design and give out to the public, which is, one of the ones that have come back is bank statement loans. And that's huge for self-employed borrowers who maybe have too many write-offs, or they're on paper, it doesn't look like they've made money, but they know that they make money. And so they can provide 12 months or 24 months worth of bank statements and actually get qualified using that income.
Yeah. I mean, that's such a Achilles heel for the self-employed folks that are, trying to save some money on tax season. And it comes back to bite you in a big way.
I know.
I mean,
nobody wants to pay Uncle Sam.
No, they don't. I mean, especially those of you like in the service industry who get a lot of tips. I'm not going to call people out, but I know some of you in the industry not claiming all your tips, because that saves you a lot in taxes. But that comes back to bite you when you're trying to buy a house, because you can't use that income to qualify at that point. Okay. Thank you all for hanging with me. I remember what my point was before, so let's circle back to that. You're going to start seeing a lot of like really creative marketing, a lot of really creative financing ideas out there, probably as we're moving forward. And I really think like, let's see, like assumable VA loans, like I've seen those like really come back, and everyone's looking at those. Like those are like the thing that's really going to make the difference for some folks. Can you talk about like how something like a VA assumable loan might not necessarily work in every case? Because I mean, I've run into this multiple times.
Yep. So for the VA assumable loans, they're, pretty straightforward. However, they can have some of those caveats in them. If you have a service member trying to sell their home as an assumable loan, to keep the math simple, let's say that they are $400,000 on their home, but they're selling the house for $500,000. The person that comes in to assume that loan is only going to assume the property for that $400,000, and they're going to have to come up with that difference of that $100,000, a different type of financing that's not going to be a traditional mortgage. Whether that's you have cash on hand, whether that you take out a personal loan, something like that. So just keeping that in mind. The other thing is if you have a service member who's selling their house as an assumable loan, and a non-service member is assuming that property, that service member has to understand that is going to stay on their entitlement until that person that assumed the property either sells it or refinances. So they have to be okay with that remaining on their entitlement, even though they've given it to somebody else, because they don't have entitlement for it to transfer to.
That certainly does make sense.
Yeah.
So I'd say that point and kind of point that out just to say that you're probably going to be seeing like a lot of really, silver bullet things like that, where it sounds great. Hey, I can step in, I can get this interest rate where they paid for it like back in 2020 and now it's like 3% and that's awesome. Maybe yes, maybe no. Like actually talk with the people who kind of know the ins and outs and the numbers to see if it actually makes sense.
Yep. And you're dealing with that seller's servicer. You're not going through like your lender to do that. You're dealing with the servicer, and those are like, we see them fall apart more often than not. And they can take, over 120 days just to close.
Yeah, because I mean, think about it. If you're the person holding that note, like they have zero loyalty to you whatsoever. I mean, they're getting paid one way or the other.
Right.
So to them, it's almost like a courtesy kind of a thing. So it's, zero motivation for them to move on it quick. But yeah, you're going to see more of that probably moving forward. But yeah, just be looking for that stuff and kind of buyer beware.
Yes.